Hi, my name is Robert. I am the principal investment manager at Pure Value Capital LLC. The information contained in this podcast is for educational purposes only. It does not represent our view of the current securities. It does not represent an intent to sell these securities, and our positions in the investments might change. Please consult your own advisors before making a financial decision. We're here for educational purposes only, and hopefully you enjoy the listening. If you happen to be an accredited investor and are interested in invest, feel free to reach out to Robert at purevaluecapital.net. Thank you. Hayden Pester, welcome to Pure Value Podcast.
All right, thank
Even
you, Robert.
though we work together all the time,
Yep.
and we see each other often, but it's a different format, and we get to chat in an official manner, which is great.
Excited to go kind of more in depth on what we do here at Pure Value, the kind of approach we take to portfolio management and all that. So
That's right. And this is a little sort of warm up too before we have the annual Pure Value meeting.
Yep.
So this is recording in mid-April, and we have 2 months till June to have some of our investors coming together, and that'll be a great time. Why don't you tell us a little bit about yourself and your thoughts around investing and how did you get started, and then your sort of pre-joining Pure Value and post-joining, and how has you're envisioning your career changing, or how you're thinking, and all these things. Just to give me an official lens of your briefing of that. Actually, it's good for me to learn again as well.
Yep. All right, I guess I'll start real quick. I went to California State University Fullerton, recently graduated in May 2025. While I was there, I had the pleasure to have some great mentors from the Titan Capital Management program there. We actually managed a portion of the CSU's philanthropic funds, so got some real-world kind of buy-side experience before graduating, which is really helpful, especially in landing this role. So
Yep.
owe a lot to that, and through that kind of gained a lot of exposure to the bottom-up security selection. I managed the equity portfolio. We're pretty concentrated here. That fund was even more, a little diversified. Some would say 20 to 25 names is already concentrated, but compared to what we're doing here, it's fairly diversified. So got some great experience there working with mentors, one-on-ones, had professors that were really real-world portfolio managers. So great experience there. And then that kind of gave me the stepping stone to kind of move over to the real world into a real buy side here with Robert. I think kind of what made me want to pursue a career in this industry is that investing, one, I think I just like the in-depth research process. I kind of found some solitude within doing that, just within getting into the nitty-gritty kind of deeper work. So it's kind of a peaceful process for me. And then also kind of, I guess, lifelong learning. The stock market's always evolving. There's always new facts coming out. There's always new opportunities to invest in. So really just kind of endless learning and endless pursuit of bettering yourself. And then also kind of within that solitude part that I mentioned, it's also kind of, I guess, like a solo game in a way. I mean, we work as a team,
Yep.
but at the end of the day, I think it is kind of just you versus everyone else, at least in what we're doing.
Yep.
It takes time, it takes patience to watch your thesis play out.
Yep.
So there's kind of a lot of, I guess, stress. And then also you kind of need to take a lot of just believing in yourself and really having high conviction and not kind of worrying about what others are doing and just focus on what you're doing, change your mind when the facts change, and kind of just be willing to sit it out, write it out, and have confidence in yourself is the best thing. So
Yeah, that's right. That analogy I like quite a bit. I think there's this, if you use the great individual sports, for example, like, we had Masters over the weekend, Roy McIlroy winning, in golf. I'm not a big golfer, but using it as an example, or it could be a boxer in MMA, or it could be tennis, right? So I think more as it's almost like two tennis players training together in a way. The game is, people think of it as more as a classic team sport would be like something like basketball or football or something like that. This is maybe at its best could be some way of American football in the sense where there's a quarterback situation at a PM level, and then there's sort of teams of research from the end of receivers or sort of linebackers blocking. But generally, I think it is a game kind of, especially for each individual investors who manage their portfolios, or each individual fund managers, right? There's this constant pursuit of knowing what you're good at and processing, digesting information, and then getting better at the game of tennis or boxing or golf, if you will, as an individual game. And people can play together. That's what I choose to sort of grow the team, and Pure Value has been around for the last 9.5 years, but the goal is to, and also it is more fun to work with people. I think that's the big part, after you join as well. So, any sort of investment philosophies, or even just, how you think about things, or even the habit of reading different type of things, or any, I can guess, where I have a general idea, but it's better to hear from your perspective of ever since you joined Pure Value, how has things evolved?
I think for me, kind of starting out, at least as an investor, a lot of people even most general population knows the name Warren Buffett and knows that he was one of the greatest investors of all time. I don't know if too many people know the actual kind of strategies and how he started out and the whole story with Charlie Munger and all that. I think starting back, Warren Buffett, student Ben Graham, so kind of more value oriented, not so much quality, just kind of what's cheap and then screening for it, modeling it, having your margin of safety and all that is kind of how I started out. It's kind of like a rinse and repeat process, I guess, in a way, compared to some longer term compounding growth investing. So initially just finding things that were cheap, and maybe you have like 30-40% margin of safety on your DCF, and then kind of see the mean reversion of that value and then swap out, find the next opportunity, kind of rinse and repeat. It's kind of like the cigar butts, like find something cheap and then get what's out of it and then move on to the next one, is one of the analogies that both Graham and Buffett have referred to. And then Charlie Munger kind of came in, taught him more about the quality side. So finding not only cheap businesses, but quality businesses at a fair price rather than a terrible business at a great price. So you got to make sure that you really know what you own and that it's something that you're comfortable holding forever, not just kind of for the value to converge or be realized by the market. So that's one thing too. And then especially since I came here, you kind of ingrained some of Phil Fisher's work into me. So doing that and then getting kind of the growthier tilt and more of the longer term. So that's one thing that I've really learned about, especially since joining, is kind of not only learning kind of like what value is, like I previously mentioned through Warren Buffett, but then also being able to think about it from just like a longer term perspective. How long can we underwrite this for? Are we really comfortable holding it for say 10, even 20 years? If the market closes and you can't exit this position for say 10, 15 years, are you really comfortable with that? And I think going back and looking like at some of the other work I've done, like one of the companies that I was bullish on, and I mean, I thought it was an all right company, is Dollar Tree, but would you be comfortable owning Dollar Tree for the next 20 years? I don't know necessarily what the terminal value is on it. It's easily replaceable. Lots of just kind of, I guess, not essential to some people, but it's pretty low switching costs. And so, and thinking about then something like Meta is one of the ones that we're, I guess, bullish on here. And thinking about that from a long-term perspective, I think there is long-term staying power there. It's where people go to connect. It's where you go to connect with your family, your friends. It connects you with people all across the world. So I think just learning about different business models and then kind of being a generalist and being able to compare one thing to another is one thing that I've learned. So.
Absolutely. And I think one of the things that people sort of think about the world of value investing is they focus on the world value, right? And then I think here there's just, and obviously because for professionalization of things, during the industry grew, and especially mutual funds and things like that, there's this distinction between value and growth. You can find a direct quote from one of the Berkshire annual meetings that Buffett talk about. There's no growth investing, there's no value investing. Value investing itself, including growth. That part, I think he says that explicitly. And I always thought about this: the world value. How do we define it? And obviously, we're at pure value capital. Why do I add the word pure to it? It's this: if Anthropic's revenue is growing from 9 billion to something around the line of like 70 billion, the valuations I think yesterday come out to be 850, whatever the case. If a company, this is not AR, this is MRR. So if a company is doubling their annual revenue base every month, then the future part of growth obviously should be incorporated in part of the value equation, right? Or essentially, in short, I think this ancient old thing, again, Buffett talked about this, is that value investing is not cheap investing. But a lot of people think, oh, I found a value bargain if they go buy something or something like that. So people use value in that sense, right? But value here, meaning we talk about valuable. Valuable as in, like, say, if you have a valuable friendship, a valuable relationship you want to maintain, or a valuable family relationship, if you have to fly across the country, go to another coast, go to Florida or New York for a certain, to see a friend, to see a family member, let's say, and it costs you, let's say, 12 hours traveling, plus 3 hours time zone, plus, let's call it flight tickets $1,000 each, then is it valuable? The key is about, do you care about the relationship? Correct? Do you love that person? Do you have a connection?
Yeah, it's not just the value you pay, but you get the sentimental value or the emotional value out of whoever you're going to visit, whether it's loved one, girlfriend, family. So
right, there we go. So I think a lot of that intangible aspect is in the quality of the business, right? Let's say if Claude plugins may be embedded in every single piece of software, that every single kid, from the education system to professionalization of industries, everyone can use it. Then okay, what multiple do you put on that, right? So in that sense, I think there is a lot of this idea around people talk about like value, what's tangible, what can be seen, versus to extrapolate like what is actually, especially for businesses that grow at such a rapid rate, right? To embed those things and the qualitative, the dominance of certain industry, the moat for certain players that you mentioned, like Meta, right? That has the human nature of people want to be connected on similar platforms, right? It'll be ridiculous for people to use like 27 different platforms to connect, right? Generally, it's one or two, or for messaging apps, right? Generally, people, right, to go for messaging apps is to message each other, right? So So Apple built a moat around that, right? Blue
Yeah,
versus
with
green
iMessage,
text, right? So as a very subtle thing, who knew it would be a big thing, right? So because technically, and then we can use that as a case study to start in a sense where, like, if you think about, technically when Steve Jobs launched the first iPhone was October 07, right? It's even a little bit, well, I was in middle school. It's a little bit before my time, right? And you were, 6 years old
I was
at
in
the time.
probably first or second grade.
Yeah. And then, so technically that would be a very boomer product in a way, right? But over time, because the interoperability of this ecosystem, right, including iMessage and things like that, people don't want to even be on the other side of the green text. So therefore, then you have
it became like a status symbol in a way almost.
Exactly. And then, or among family members, you could have, let's say, 8 grandparents and parents and uncle and aunts and stuff. If you have a large family chat to share your vacation photos, like if one person's green, then the whole chat becomes like, the photo upload doesn't work as well. It's low resolution. But if everybody's in the blue, you see how things are sent out. So a lot of things I think are like that, or like what kind of multiple do you put on those qualitative aspects, right? That's obviously eventually they come to something tangible, right? As I insisted before the podcast that I have something like a DCF in front of me and stuff. Like eventually the numbers show up. But I think understanding why the numbers show up and how the numbers work, it's a lot part of the work. And I think that part, it's from my humble opinion, I think it's also undertaught in school in a way, right? I think school, the nature of standardized exam is that to examine what's tangible, what can be tested, right? Or the nature of like a modeling competition, right? But essentially, life investing comes down to a few high quality decisions that people make, and those decisions generally come from a lot of instincts and intangible things, if you will. So, yeah.
Yep, totally agree with that too. It's just kind of, it's really at the end of the day, it's kind of understanding the people that run the business and then also the product that they offer, and then comparing that to everything else and trying to find maybe, because you used Apple in this example, and then just trying to find who kind of like Apple seamless kind of like software integration across their hardware ecosystem, and just finding something that really is the top player in that space and just owning that for decades.
Yeah, and also distinguish, and also there's a danger in that too, right? There are risks there where like something like HP and Dell were traditional, they made computers through the 90s and stuff like that. So the argument in 2016 when Buffett bought Apple, and the idea of that, when it was so cheap, it was trading basically about 10 times pre-tax profit, 10 times EBIT. What happened was, people thought it's going to be a hardware maker, and eventually everybody's going to make smartphones, and smartphones will be a commodity, and people use different brands, right? But then they put innovations on top of it. So a lot of things look easy in the hindsight. This is another Buffett quote of, in the business world, I think I would argue that's in life too, that it's the, I believe he said the windshield is, it's a lot more blurry, or the rear view mirror is a lot more clear than the front windshield. So when you look back, hindsight is always,
always 2020.
Always 2020, this should be that. But then at the time, people can go, okay, this extrapolation, right, might not work. Just as, if you put let's say if people analyze Tesla today, if you put a instant multiple, or let's say the probability rate of becoming the world's leading autonomous driving technology, that everybody's going to use their software and their integration, use FSD, not only just on Tesla cars, but on every single car.
Every other car.
Or they can deploy every car to pick up people from everywhere. No taxis, no Uber, all that. Then okay, well then the multiple is too cheap, right?
Yeah.
Then you kind of deploy, and then if you add on top of humanoid robots or something, right? So there's this art and science aspect of like what part is really imagination, right? You can price imagination, and then we go into the world of gambling and speculation. Okay, that's fine, but that's not investing. You can where is the fine line between imagination? Where is the fine line between like a qualitative aspect that is not being interpreted by numbers, and then we shall embed that in, and what is the actually concrete numbers, right? So this you would know exactly what I'm talking about, since we just talked about this last week. Concrete numbers would be something like the tragic algebra, right? For those who don't know, it's sort of backing out Michael Burry's, backing out SBC's like owner's earning, right? And then again, I have no affiliation, but I'm almost doing a advertisement for his Substack, for his Substack subscription, right? So apparently, and he's making more out of that than his fund. And then for anyone who's interested in fund economics, it's true. If he was managing about 150 million or something, I think at that AUM actually, I think he has about 30,000 subscribers at $1,000 a year a pop. Like if you do the math anyway, from where I'm sitting, I think that is a higher ROI number for economics. Anyhow, so if you go from what's concrete, right, backing out stock-based compensation, going through diluted share count, and actual true catches to owners' earnings, right, those are concrete things. Then there's the medium where like what is like a moat, right? Like Meta's, network effects with a moat, right? They currently have it, right?
Yeah,
Not saying the glass is going to take off or something. This is what they currently have. Then you go towards like more future prospect of like, there's the art aspect of like what can they deploy cash in. So I think the best business probably are where, and this is I think generally like people too. So in the way where you are let's say we're good investors today. I think you are a good investing prospect in the industry today. Then also you have something that's great you can grow into. That's generally how people are and how businesses are. I think a lot in that ways. Where if for a business that if currently they have something pretty big, pretty well-defined moat and pricing power. A lot of times, moats literally comes down to pricing power.
Charging 10 to 20% just because of the premium quality associated. So
that's right. Especially for smaller, ticket items. And this again going imaginative too, right? People thinking this in the sense where like it can be you can go from like a Spotify to Starbucks, as in they're completely two different businesses, right? But a $10 a month a Spotify subscription can go up 12%. Would that be $11.20, right?
Yep.
It's not even a huge increase for people who have the playlist to have the situation, right? To have the subscription, but you want to keep the same account with the playlist, with all the embedded features that's in there. Versus, let's say, if your latte goes from $5 to, I believe, 12% increase would be 60 cents, right? $5, 60 cents, which people are paying that these days for lattes.
Even, Starbucks, kind of like real world example, like we had talked about before. I think prices may be cumulatively up since like pandemic, maybe like 2020 to now.
That's right.
Starbucks price is probably up like 40 to 50%.
That's right.
So you're going to get a latte for $5, relatively cheap, but now say it's $7.50, $8, tip $9, you're almost at $10. That's right. Is that really worth it? And especially every single day. So I think models like that, like Spotify or Netflix, like you said, they could raise it maybe 10, 20% a year or every 2 years.
Yep.
People don't really bat an eye. But for coffee, if you're paying $10 for a latte, you can make a cup at home for probably less than $2.
Exactly. Then you pricing power diminishes and those type of things. So I think
there's a lot of other options too for Starbucks. There's a million coffee shops in every corner. So
exactly. And the switching costs, right? Like if essentially if you get your music, like Apple have it, YouTube has it, right? Spotify has it.
Yeah, but there's also value in kind of the algorithm, I guess, too, that Spotify has built for going for Starbucks versus Dunkin' versus Dutch Bros. It's pretty, easy decision to go to one versus the other. I think switching between, say, like Tidal, Spotify, or Apple Music, the algorithm's kind of built up.
That's right.
You have your Wrapped at the end of the year kind of knows you. So
that's right. Yeah. Or it's kind of like a platform power where like, we study DoorDash, right? You can switch restaurants every day if you want novelty and try new things, right? I think a lot of eaters want novelty in a way, right?
Yeah.
But at the
There's
same
always
time,
deals, new things to try. So
yeah, but platform-wise, is it really like today's lunch is Uber Eats and tomorrow's DoorDash? Like,
yeah,
right?
Probably, there's no reason to switch between the two. So
unless one gets a subscription from this end, and maybe that gets a little deal and things like that. Maybe, or again, platform power might drive down to the same pricing in a sense where with LM discovery, these things might change, right? So that's also the part like the future. This I think Steve Jobs said this in business, but also applies in investing. It's not where the puck is, where the puck is going matters, right? So this one single line I thought about this. Howard Marks also said this a while back. Explains I think the anybody who thinks investing is easy. It's probably a temporary thought. I would say over time it will turn out to people one way or the other. It's not. It's because everything all the data we have, everything we read about, it's about the past. You can get the latest quarter's earnings call. You can talk to the CEO today. He can tell you the numbers from yesterday, from this morning. If you talk to like Shopify CEO, for example, he can tell you the live commerce transaction right now. Not the next minute though, just the last minute. You can see on these dashboard, everything. So everything we know is about the past. But every decision we make, it's going to be
based on the future,
Yeah. So that's the hardest part. That's essentially the decision making. That's why
gaining a sense of confidence kind of in what that future story is going to look like. So
how's that experience been like for you so far? As you went through a bunch of investment meetings here, and we worked together on different things and talked whether on Slack, online, offline, in person. What was it like for you?
I think that's probably been the biggest source of learning for me is kind of that long-term thinking. I think a lot of the kind of like work is kind of like more maybe like sell side-ish kind of like oriented, looking just kind of like at the historical facts, what's the growth trajectory, what's the industry kind of, what's this company's market share, and then maybe identifying the best player today, but are they going to be the best player tomorrow? If you invest in somebody that's good today, you really do have to make sure that that staying power is there, that you can underwrite that sense of terminal value. I guess kind of going back to platforms like we were talking about, Uber versus Lyft. Uber, I mean, is obviously the much bigger player there. They kind of have that network effect, critical mass. Lyft is maybe the second best option. Maybe they're 5 to 10% discounted, but there really is no terminal value. There's no sense in necessarily investing in the second best. And I guess we can't say here, we like to focus on people. Wait, can I say can we cut it for a second? Am I fine to say like our philosophy and like talk about
course,
like,
of course,
okay,
absolutely.
okay.
Yeah.
Okay.
Of course, the 3 Ps. Go ahead. Yeah.
Okay, so
but
here,
make sure people trademark that. That's our original, right? You haven't heard this anywhere you study investment before, right? It's not part of any book, right? And that's kind of, I had this wow aha moment like last year, April last year, actually around this time. After 9 years in, I started in 2016 September. This was like May, April 2025. I was like, when I start building my team, I need to have principles around it. Because principles starts with the P. And I was like, pure value starts with a P. I need to think about like, what are the 3 criteria? Because every time I make a decision, it's kind of all congested. My brain, and this, I hope from a lesser degree from a mental health standpoint, but I'm going to use the Elon quote. He said, my brain is a storm. You don't want to be me. You don't want to be me. You heard that, right? Occasionally, I feel like that, especially when it comes to very hard decision making, like a very concentrated position. And again, most positions, I didn't take them to be a concentrated position. There are examples. There's one when I started. You probably know. I'll give it to you again. But it generally, because they've done so well, so they grew to be a large position, and they're a phenomenal business. I'm like, what do I do with them?
Well, the story hasn't changed. You just have to kind of keep reassessing quarter after quarter.
But they're like
sure
75% of your personal net worth, and 80% of your fund value, and it's like goodness, right? There are things like that, or there are March 2020, there's crisis moments. Anyhow, so my brain is storming sometimes, so I'll go, how do I clearly define the criteria when I made those decisions? What did I look for? Then came the 3 Ps. Go ahead. Yeah.
Okay, so what I was going to get out with the 3 Ps, people, product, price. And then obviously with Lyft, the product is nearly essential, or essentially the same as Uber. There's not much long-term staying power in investing in the second best. Maybe if the price gets low enough, which is one of the reasons we were looking at it. But after kind of doing the work, I don't think there was enough on the people side with the management behind it. And then also with the product itself being an essential copy, you're not going to get that much out of investing something, even if it's dirt cheap. The product's essentially the same, so it's something we ended up passing over. And then kind of mentioning that long-term kind of like staying value, looking at something that has terminal value you can actually underwrite, whether it's like an asset-heavy business that has, say, ships, trucks, anything that's kind of like an industrial asset that really does have long-term staying value that kind of, I guess, can buoy the valuation in a sense, making sure that your downside is there. Your downside protection, so to say, knowing kind of like what's your maximum loss in a scenario. Say we do a DCF, bear, bull, base case. On the downside, say we have like 25% downside in the absolute worst case. That's really good to know going into a position because we know at the very least or very most, maybe 25% downside. But then say in the best case possible, which is kind of what we assign a higher probability to anyways, we think that kind of like the asymmetry of risk is there kind of. So knowing is the risk reward worth it? So
yeah. And also when the facts change, we change our mind a lot of times. Where like, for example, like Block, right? We I don't think when you first joined, we were covering. We talked about payment space and stuff like that. But I don't think it was a company I ever mentioned.
Yeah, Block is one we've gone really in depth in now. So
right, and tell the audience that piece of story. How did it come about?
I guess Block is one thing where we really did change our minds when the facts changed. Jack Dorsey came on the last earnings call, said that we're going to slash 40% of the workforce. He's kind of laying out a whole new plan basically for a company for the future, essentially how our company is going to staff, what's kind of like the white collar job market going to look like. He's kind of eliminating any sort of middle managers. It's just him, and he wants basically every employee to report to him, player-coach kind of model. So he's the coach kind of watching all of his players, and then they'll report back to him. So I think that's something that we really changed our mind on. One, they're also two. I mean, they have the good product in place, Square and Cash App. Cash App is now one of the biggest debit card systems, leading for lots of Americans. So provides kind of an essential service, especially for people that are kind of like gig workers. Maybe they're unbankable. Lots of reasons to use Cash App and lots of addressable customers. So they're picking up use there. And then they have the Square payment system side. So they kind of own both the business side of payments and then also the consumer finance side. So they get a really lot of good insights with their product, which then enables them to also loan to consumers and to businesses. So they've really done a great job just building up that product ecosystem. And then even in some ways, like they combine the two. If you use a Cash App card at a Square terminal, you get like 1% cash back or something. You get X amount of cash back extra. So just for kind of staying in the ecosystem and feeding their data loop. And then obviously with a visionary leader like a Jack Dorsey at the helm, there is some sort of that people aspect and kind of seeing him. He says even that like we may break things along the way. He knows that this isn't like 100% certainty, but he kind of laid out his framework for why he thinks this is going to work, why he's going to do it. So investing in something like that where we can find a leader that kind of has a plan that we agree with, and then also kind of like a clear path to further upside within the company. So.
Great. What I just thought about this, you take some time to think about as well. If there's a good example comes to mind, what is something? It could be a company, it could be an investment style, or it could be what you thought about the industry or something. What is something that definitively you would say you change your mind on before joining Pure Value and post?
I think the one thing kind of, at least, is like I mentioned with Phil Fisher and kind of valuations, he's mentioned, and you've mentioned to me too, because when I asked about like owning something that's, I won't say company, but this company at 40 PE, maybe it's overvalued, should we sell it? And then when selling, you incur kind of the taxable action. So that's one thing there. And then being able, it's comfortable to hold these companies at higher valuations and just being able, because one, it depends, do you want to ride this company out? Do you want to try and take profits and then buy it back lower or whatnot? So just being comfortable holding something, as long as the story kind of changes, the macro environment may change. And obviously that's going to impact the stock market valuations and an independent company too, their valuation. So just being comfortable with the story, with the company you own. And even though the broader environment might change, as long as people behind the company stay executing, they stay on top of things, and the company's kind of maintaining its competitive position, even though the overall economy is worse, the stock's going to go down, but competitive positioning's the same, product's the same, continue to evolve, same people at the helm. I think that kind of just longer term thinking and growthier kind of oriented thinking about investing is one thing that I've really picked up. So
good point. Actually, I thought about this. I used to tell a lot of people, sort of my friends or people not even in the industry this, but I think the hardest part is, people think about a lot of times investing from a trading perspective. Then trading, there's two actions: there's buy and sell, right? I tell people the hardest part, and it's an art. It's holding, right? Holding a lot of times because you can open, you can see a fund's portfolio, you can look at a 13F or open our like client's portal or something. Then you go, wow, okay, 20 days went by or a quarter went by. The major positions haven't changed or something. That doesn't mean we didn't do any work. It's like I think about it every time I go to the toilet. I think about it every time I wake up, right?
Yeah, you're constantly like to the client, it may not look like you're doing much, but on your end, you're thinking about it 24/7. You're always reading, updating models, trying to maybe get some expert calls or channel checks in. So you're kind of always working, even though it may not seem like it.
Yes, and I think that part and connect to what you were saying before. About like the sell side aspect of thinking and versus like the looking at long term as business owners. I think the big part is incentive structure matters, right? So it's that generally from and then I'm working out to have a Pure Value incentive that aligns the team as well. It's the sense where like because you want to look at whenever somebody gives you an opinion. This is in general in life, like you want to not only look at obviously does the opinion is it valid? Do they have wisdom? All those type of things. People try to do that. But you want to look at where their butts are sitting from, right? So in a sense where, because the model has always been, I type just like Buffett did, just like, and certain fund managers do that too, right? Remember from macro perspective, like Stan Druckenmiller or, more fundamental investing like Bill Ackman, the ones who relate to our concentrated long portfolio situations. Anyhow, if you see the GP capital, so much is with, like, there's never been a period of Buffett talk about 80% of his net worth is always tied up with Berkshire's shares. There's never been a period in my life where 90% of my investments are not in the Pure Value funds, not in the same exact same portfolio as our LPs. And generally speaking, obviously that's not 90% of their total net worth. Yeah, so actually the stakes are even higher for me. Yeah. So basically, essentially every dollar deployed, I think about it a lot deeper.
It's your own money. Obviously, I mean, they may not see you working like we mentioned, but then 90% of your money's in there. So obviously you're not going to be messing around. You're going to be constantly watching it. Yeah. And even if your money wasn't there, you have the fiduciary duty anyways. So I mean, at the end of the day, yes, we're always going to be as attentive as possible to the positions.
Yeah, and therefore like a 50% position will be a 45% position for my,
for your personal net worth. So.
Yeah, so that becomes a big deal, those type of things. So I think generally from that perspective, it is a lot of this, then the processes become this, caretaker, from perspective. I tell people like, I don't think as too much about the returns. I mostly focus on the risks. When the risks are taken care of, the returns will be there, right? And I think versus the sort of the more promotional side of finance, the sales side and those type of things, I think there's a lot of aspect that's essentially the goal is to have a transaction to happen.
Yeah, you want people to trade because then you're JP Morgan, you're writing reports.
Yeah.
People buy what you sell them from the reports. So
yeah. And then if the stock, and obviously one-sided or one-direction trade is easier to call down and easier to sort of set a price. The stock move from 100 to 120, set a price down to 150. So there's more of that. And then if they're not doing well, of course you got to have a sell situation. Be like, hey, look, you guys got to get out from 100 to 80, 80 to 75 and stuff like that. Anyhow, I think incentives set up a lot of this. It's not that anybody, I definitely do not have superior intelligence. I know that for sure. Maybe a little bit of wisdom, but I don't think I have any intelligence edge over other market participants. There are a lot of smart people. But it's where, how does the incentive set up? And then given the rigor and the deeper thinking. And then given even more, think about the actions and decision-making process, even in more delicacy. So you mentioned the book Common Stock and Uncommon Profits by Phil Fisher. Another book impacted me a lot. It's the Thinking Fast and Slow. It's actually How to Think by Daniel Kahneman. I believe he won the Nobel Prize of Economics in 2013. That particular book, I read it exactly your age, 24 when I started. I was on flights to New York a lot, and there were 6-hour trips one way, both was 12 hours. I remember reading that. Probably on my 4th trip to New York, I finished the book. So about, let's say, 24 hours of reading. I finished the book. It was life-changing in a way, because it really looked at confirmation bias, anchor effect. Like anchor effect, for example, like if you subscribe to Wall Street Journal at $9 a month, it's $34 now. If it's $9, what happens is that, or actually no, let's go with 34, the current price for WSJ. And then what happens is that if they ever go to like something like 32, you'll feel like it's a great deal because you used to pay 34.
Yeah, you're used to that higher price, even though say that's double what it really should be, but then they give you like a 10% discount. All of a sudden there's that value perceived.
So there's an anchor there. Confirmation bias, and you probably noticed this just in general, and it's okay to, it's human nature, we all do it. But when it comes to decision making, it's harder in the sense where like, people generally, this is the best example would be like politics, right? When people discuss politics, generally they look for some information that's going to confirm their current existing view.
Yep, and then ignore anything that could poke a hole in their thesis.
Yeah, so any evidence that supports that thesis, you want to toss it in there. But that's okay, because generally their outcomes and portfolio outcomes, generally people talk politics as a after dinner thing, as a, it's inconsequential for the large part, let's say, for their life, right? The discussions around it and stuff like that. But when we run our investment meetings, if we allow all confirming behaviors, let's say we have a 12-stock portfolio, 8-stock portfolio, we went through all of them. One can be a restaurant delivery app, can be a DoorDash. The other one can be a Spotify, can be a streaming app. The other one can be a Meta, right? So all we talk about is confirming, wow, this is such a great business. And Robert, hey, look, the price is also good. Let me manipulate some numbers here. This looks awesome.
Yeah, tweak our model, 50% upside.
And then everything's been good. And then, hey, America, everybody, it's coffee is the number one vice, number one substance, whatever. Okay, so you go find Dutch Bro Coffee, find Starbucks, and be like, hey, this is awesome. Then we write some numbers, and I'm like, I can't disagree with you. Caffeine is great. And then people do that. Then then you're confirming a view. Where, let's say, where Disney has a moat around it, or Nike, wow, the almighty, the dominant, the swoosh, the swoosh to just do it, and a 10 years return is minus 6%. I believe Starbucks' 10 years return is probably Starbucks did okay. Something around 60% in 10 years still trailed S&P by a lot.
Yeah, I think Disney's maybe 30% over the past 10 years.
Okay, I was looking at yesterday. +4 10 years, and then Nike's down like 6. So essentially, these are like flat in 10 years. But then 10 years ago, if you have this discussion and be like, hey, look, this is great. And 10 years, obviously, you have a lot of time to adjust positioning, adjust the portfolio, buy more or sell more, or hold, right? But imagine those meetings, every single one of them, they all compound just like money. Right? They all compound interest, like 8 to 1 in a row, they all compound.
Yep.
Then each time we confirm Disney is great. We confirm Nike is great. Then look at what it turns out, right? So that's the time, things change. That's also the part around moat. And also that's the part around pricing too, right? Because this whole terminal growth value of 3% thing, like until perpetuity thing, that's why I always kind of erase that, right? This whole writing out a 20-year version of like something going to grow at a certain percentage. those aspects have to be carefully examined too. Yeah, if that makes sense.
Yeah, 'cause I mean, like I know at least for kind of for Nike and for Disney, at least they both kind of round tripped over the past 10 years, both probably peaking 21, 22. So you could have bought it 10 years ago. Was a great business up until 2020. Well, great business nonetheless today, but great price in say 2016. Price got really iffy probably in 2021, 2022. And that's really why price is one of the things that we have to focus on as well, is because it was great until then. Valuations got stretched, and then you kind of need to have the vision and have the understanding of valuation and the market fundamentals kind of to size appropriately, watch risk.
Yeah.
And then like we mentioned, the downside cases.
Yeah.
Disney, the downside case in 2016 is definitely nowhere near as strong as it was probably 21, 22. So.
Or DoorDash, phenomenal business, right? It traded off the bottom of December 23 or something by, I think, $40, $60 a share. Now it went 80, so dashing 2 years, like 3x, right? You do the compound return on that. I believe it's over 30, 40%, whatever, annualized. But guess what? It went public December 2020. After 1 year, so November 2021 was the peak price. So actually, if you look at 5 years chart, DoorDash actually returned 0% in return. So the price you buy matters. So I'm saying, so it looks like this. Right, goes public, goes here, all the way down.
Yep.
Going back up. Or if you bought Shopify in November 21, guess what's your return? 0. If you bought it December 23, guess what's your return? 4x. So it really same
timing
company.
And then price is probably, again, I mean, you could buy a great company at a poor price. Doesn't matter if you bought the best company in the world and it returns 0% just because you bought it at such a sky high valuation. So
yeah. So it's a balancing act, right? So and I think we just talk about product and price. People stuff.
People at the end of the day, we need
world.
that. You need the greatest people running it. So
yep.
That's like you mentioned, being like, I guess in our sense, the people, me and you, highly, I guess, aligned with the fund in a way. So
yeah, I think it deeply, that's spot on, because deeply, I think from a first principle, a company, it could be an investment firm, could be a law firm, could be a company makes shoes, and Nike's case make products, and Disney tells storytelling. I wouldn't even say they make parks. So let's just say they do storytelling.
Yep.
And then at the end of the day, it's a company is a bunch of people getting together, produce a product or service that's valuable to the world, but also can charge somewhat higher than their input cost. And that you have a business, right?
Yep.
You have revenue.
Selling it for more than you can make it. So
yeah, people will pay for it, so that's revenue, right? People will pay for it, it's revenue. You have but you have a cost to make this service and products. Then you can actually charge a price that's slightly higher than your cost. You have margin. You have both, that's a business, right? You have the first one, that's nonprofit, right?
Yeah.
Because you don't have a margin.
Yeah.
You have the second one, you have a margin, but let's say you don't have one person buy it, then it might be a very, very small, or a business is not scalable for shareholders investing and having an entire enterprise process. So from that perspective, at the end of the day, it's the people who get together and the culture that's built around it and how those things happen. Or look at it, or you can pull the data of, again, this. People can say this is coincidence, but you can pull the day in 2021, when I believe it's March, when Jeff Bezos stepped down to Amazon's performance till today, right? Pretty average. I believe, I think maybe went up a little bit, but it's relatively flat from, again, 5 years now. It can be a founder. A lot of times it's not a founder, but nevertheless, great managers. When we bought GE Aerospace, right, in middle of April 2020, right, Larry Culp took over 2 years before that, and really did the lean operation, did the turnaround. COVID hits, entire aerospace industry went down. 2 years later, he decided to spin off the companies. Each company thrived, right? GE Vernova went up like 11x return or something. GE Aerospace itself like 4x, quadrupled. GE Healthcare is doing reasonably well too. So like the right person making decisions and the right team and the culture that they can build around it also matter a lot. Right, so I think the people side is the hardest part, and that's not available on any DCF. That's the part people have to underwrite. What type of, or John Danaho's version of Nike, how did that lose its place? Can Elliott Hill turn around? These things are all hard to underwrite, right? Or the people, everybody, in Warren Buffett bought it in 2016, but even before that, everybody had to underwrite a decision in 2011 when Steve Jobs passed away and Tim Cook took over. What is the product moat around Apple? Yes, that's one decision. If we go with our 3P pure value framework, right? There's the people side, right? Because we don't know who Tim Cook is. Then you have a price situation, right? So you have to have, essentially when Buffett bought it in 2016, Apple was at what, 10 times EBIT?
Yeah, 10-ish, yeah.
So right price. Tim Cook was confirmed that, he was great. He was the supply chain specialist who made sure Steve Jobs' vision was executing. Also making incremental improvements and innovations
he kind of
on top
unlocked
of it.
more of the SaaS side of Apple too, all the recurring
Watches,
subscriptions.
The AirPods Pro, those type of things. Nothing major, nothing big, as in like the car didn't go well, or those type. Nothing like a huge vertical to grow into, but everything was incremental, right? So that's his style. Then you have the product that obviously still had a dominant position in smartphones. So through all that, the three pieces of the connect. So I think people who link too much that I think investing is especially rewards this sort of aggressive patience and extreme emphasis on balance, if you will. Like a lot of times a position might seem heavy, but it's actually balanced because the business, the way it's valued across the three P's are incredibly valuable and incredibly attractive in a way. And a lot of times, those, from my experience for the last 9-10 years, it comes by every 3-4 years. It's one chance like that, and one have to capture it. And then generally, over time, the balancing, not the balancing of, so that's what people get very sort of, again, looking at tangible versus intangible traits in a way. Diverse, I believe, a 6-stock portfolio. Charlie Munger talked about this. He believes he made 3 investments in his whole life.
I was just going to use Charlie Munger as an example. You only need to make, say, 3 to 5 great decisions, and then you're kind of set for life, at least from an investing perspective.
And those are extremely diversified. So I look right. He invested in Costco, invested in Berkshire Hathaway, which he knows people. He's part of it, and knows Warren Buffett, and investing in Lilu's Asian fund. The entire Charlie Munger's family's net worth investing in 3 things. That's it. So but he knew Lilu, he knew Warren. And he believed in Costco management, and he understood all 3 qualitative aspects of things. So from that perspective, I think a lot of times, diversification to me, meaning like the 3 Ps have a perfect symbiosis, having the balance, versus over owning 100 names. To me, that's a scary thing because I don't know what the
you can't know 100 companies really in depth. So
the constitutions. What if let's say the S&P 500 or something. Which I think in the long run, most people still, number one advice, they should own index funds. They should own index funds. But if you go random diversified 100 portfolio, what happens is that, what if 40% gets wiped out by AI disruption or something? Then 60% thrive because of it. How do you price each one? How do you, that's where and at the end of the day, people go, okay, then what is the pursuit of alpha for? And then what does it matter? Well, one, Berkshire, another good demonstration of that, it's a 20% CAGR, 19.9 actually technically, for the last 60 years since Buffett right before Buffett stepped down. I believe it's the 60th anniversary. 60 years of 20% CAGR versus S&P's 10% CAGR, so just 10% more, right? Just double return. But the just becomes like something around $10,000 would be like $360,000 or something in S&P 500, so 36 times in 60 years. Not too shabby, but 6 years like basically a lifetime. If one starts in the 20s, right?
Yeah.
And then the Berkshire returns were $10,000 become like 1.6 million or something. So essentially, you have a situation with 160x versus a 30 something x, right? I can pull the numbers more exactly, but
get the point nonetheless. Yeah, and that's kind of pointing to the people and then the process that Buffett initiated, and then also the people that he trusted under him. So
or from a pure value perspective, right? We posted again. These returns were audited by ZA. Like, this was from September 1st, 2016 to September 1st, 2025. 9 years period that the gross returns at 32%, 32.53% for those 9 years. And then S&P at the similar period, I think we double check the math, it did something around like 14.5%, 15%. That's pretty extraordinary for S&P terms, right? In 100 years, that's 10.
Again, same kind of double-ish. So
kind of double-ish, slightly a little more than double-ish returns. But then S&P, the total return is about 4x, and pure value at 13x. So a 32% CAGR in 9 years period leads to a 13x of your original capital invested. So $10,000, 130 grand, nice. Could be a down payment for a house, whatever the case may be. 100 grand is to 1.3 million. That's like, some people's retirement money, stuff like that.
I was going to say that's the house, not just the down payment.
Yeah, that's probably the house. And then, but the 4x, it's going from 10,000 to 40, cool. 100 to 400, great. Like, you did well. So that's what most people should save and invest. But then the additional alpha compounding, and again, that's a 9-year compounding. I think for the next decade. On that base, right, for the initial investment, I think that initial first dollar compounds. That's why there's this Albert Einstein thing of the 8th wonder of the world is compound interest, right? That's how the rate of change really matters in that sense. It's regardless of a 10 or 12% difference or 14% difference, it really matters quite a bit.
Nonetheless, you're compounding. So that's where the real value comes from.
Yeah. And it's easy and it's hard in the way that people think, what's your intuitive guess of a 10-year 10x return? What's the CAGR, for example?
The CAGR needed to do that?
Yeah. 10 back and 10.
I think it's 14.9 or something?
It was a little bit higher than that.
Okay.
Yeah. 25.8. So a 10-year 10x return.
Okay.
But I believe in 10 years to do the S&P generally doubles, slightly more than doubles on a 9.5% to 100-year average, right? So from that perspective, you also go from, again, we're doing a lot of numbers now, but like from that perspective, you have a 10 years average return of 9.5%, which is great, but something like, 2-ish, 2.4 or something like that ish return. Versus 10 years, if one can do 25.8, again, high bar, but that's really 10 back, right? Especially for one that's young, that's early, right? 10 years later, you'll be 34, 35. Yep. And then if you 10x, that's different, different math, different outcome.
Yeah, 10x, whatever you put in the fund over by 35, it's great, yeah.
So essentially, we explain that we work hard every day to do that.
Just to do that for the people invested in our fund, so.
How about the research process? Anything, as I'm looking at a Claude like plugging on DCF here and stuff like that, doesn't have to be the price side related, but just sort of everything like industry or company research, anything. Earning season coming up again, right? You went through the first one with me
first
already.
Season down, coming for the second.
Anything about the work process that's interesting to you, surprising to you? Any stories you want to share? Anything like that, or interesting?
I think for the work process, at least one thing that's changed for me, especially even just since joining, say, late December, early January kind of, is one, the speed that we can get things done with Claude. Obviously, it's super helpful for financial modeling. Obviously, audit yourself, make sure all the numbers and everything are correct. What it's been really helpful for is like getting an initial understanding of an industry. So say you have no prior background with the payment space. With Claude, I was able to get like a name of like, say, the top 10 private and public companies. And then maybe even like, actually, when I did the whole report, it was like 15 or 16 companies that I gave Claude. And then it gave me back like a 55-page report or something. It went all the way into like competitive dynamics. It was specifically doing I was focusing on Square. So it was like 20-ish different companies comparing their kind of product to Square. What do they do? What do they offer that Square doesn't? What can Square do that they can't? So it was really easy in a way just to kind of give it that prompt, practice it, maybe practice prompting for a while. Get good at it, kind of maximize the results you can get out of that. But I think like to be able to gain kind of like an introductory, deeper understanding of an industry with kind of enough to understand a company's positioning within like 1 week, I'd say now you can become decently informed on it, on the industry, and then obviously become deeper informed on the company before you make the investment. But that's been the one thing, is just kind of the speed. You could do maybe like a month's worth of work in a week now. So that's one thing that's really changed for me. And then also working here, one thing specifically, kind of more on the price side, like I had mentioned, was like the asymmetry of returns, and then knowing kind of like your bear case, what's the absolute worst outcome, and then gauging it with what's that highest possible kind of scenario, and then maximizing kind of like the risk to reward off of like, say, a set of like 10 opportunities. And they could be totally kind of unrelated opportunities. It could be like Disney versus like ocean freight versus NVIDIA or something. 3 things, all great companies, but totally separate business models, really kind of like macro factors driving it are largely different. So that kind of generalist framing of thinking is one thing. And then the kind of speed at which we can do that is really, I think, how my research process has changed since joining. So
Interesting. Let's break down further. I think both are very good points. To go with the second one, like first, the generalist approach, like think about Disney and sort of cross universe, if you will. Like you might elaborate on that, like how each process, let's say if I were a student or something interested in investing, but like hearing that or interested in the world of business or entrepreneur, like how would you break that down in terms of that cross-universe thinking? How's the process like when you sit down or think or? Yeah.
Obviously, I mean, you have to know the product, like we mentioned. In say the case, it was Disney versus like a shipping company.
Yep.
So obviously, you have like kind of like you said, it was storytelling, and then within the storytelling, they create movies. You can go to the theme parks. You can go on a whole vacation basically. And then versus shipping, it's you put something on a boat and it goes from point A to point B. So kind of knowing what they do, how does that differ? And obviously, the products are going to be relatively uncorrelated. But then I think like where there's the most kind of overlap is you look at the people, you look at what they do with the company, kind of say we like the product on both of them. They're both at cheap prices, but then looking at like what does the people do? What is the management team doing? And one of the things I think is like you mentioned stock-based compensation, make sure they're not diluting you. Because I mean the like price of free cash flow could look attractive, but then you strip out SBC and the FCF like X SBC multiples like twice as what it's reported on just like a price of free cash flow. So going in kind of deeper on like what are the people behind the teams doing? And I think at the end of the day, if I have two companies with like a product and price that I like that are kind of like relatively the products like in a similar kind of competitive positioning, say they can charge that premium, and then also price is comparable, you really have to hone in on the people. What have they done at this company? What is their track record like? How are they growing it? Is it relatively inorganic? Do they just kind of like buy, roll up, and then just acquire their growth? And then are they funding that with their free cash flow margins, or are they funding it with debt? And then just kind of, I think, trying to understand the business model. How do they treat the business and the employees? So how are they compensating them? And then how are they kind of growing the business is kind of, I guess, the final sanity check before making the investment.
Yeah, makes sense. And the first point on the AI front of, I mean, every industry, software engineering, everything, like everybody's talking about how things used to take. I had a friend of mine, senior engineer, at a robotic company talking to me about like something that used to take him 6 months to get done. It's done in one afternoon now. That type of speed. And then and you went through school before joining Pure Value. And by the way, a delayed but formal introduction to Hayden Pester is our lead research analyst at Pure Value Capital. And then that front, with at school you did modeling, you managed money for the student club. Over the process and during that time, again, this is like maybe GPT 3.5, like early chatbot version of before Claude comes along, right? Of AI. Then there's a traditional, like when I started, I wouldn't even, go when I started, it was more like clicking links and reading through
all the blue
10
links,
cases and stuff. And then, but again, granted, I still have the internet and a good laptop and the internet connection at my disposal. Versus Warren Buffett's in the 50s, goes to the library, goes through the yellow pages and find the Moody's manual and read through and flipping it. Probably better for his eyes though, versus blue lights. Anyway, what was that process like? And how did it differ like after you joined Pure Value? And obviously with the tools, like what do you see because obviously I think it's very nuanced. I think of this pros and cons of things, right? Because reading things pre-AI kind of builds intuition, if you will, because there's a lot of raw materials being processed. And now AI can generate a lot of content, right? Like say today, for example, I believe sent a message on Slack saying like, want a one pager of something like an AI research. Because I think these days people who can output less but with highly synthesized information, in my opinion, that shows their depth of understanding of the subject versus somebody, because everybody can output a lot because really the Claude's outputting that. So in that sense, how did that research process change since you were
I guess, I think a lot of the things that you look for are obviously the same. Your investment philosophy isn't necessarily going to change because of AI, but I guess kind of how you go about it, the speed at which you can research and move through different ideas is really what's changed for me. Because I mean, before, if you want to get to know a company, you read like at least like the most recent 10K and then probably go back at least like 5 years at a minimum. And now you can kind of like, you could upload the 5 or 10 10Ks to Claude. You can say like what wording has changed within the business section, how has they changed the item 7, which is where the management kind of details everything. And then you can kind of use AI to blackline and note like any major changes in the business model and anything that management has flagged. And then also for like earnings call, there's going to be 4 a year for most companies. You can give them like 20 calls. It's 5 years worth of information right there. And then you kind of have like somebody that knows everything about this company for the past 5-10 years, however many years worth of filings you want to give it. And then being able to kind of query that and then track trends without having to necessarily read through everything. And then I guess one thing like that was initially hard for me was like to trust it. But I think it's gotten so good at being able to audit and just like click through, here's the exact line that I pulled this context from. So if you find like an interesting fact, you want to verify it, it'll just like, you can just click on right where the word is and it'll take you to the exact like line of the document that you gave it. So just being able to like trust it, I guess, a lot more than compared to when I was in school. Because when I was in school using AI, I never really used it for research or for homework or projects or anything, just because there was like a lot of still like the hallucinating and kind of like you throw it into a black box and it spits something like kind of different out or not totally accurate. So I think one thing that's changed for better is kind of the ability to audit everything. And especially like with financial models too, even like compared to probably like November, December, when I was interviewing and starting here, using it then versus now, numbers wouldn't match up. Everything now, you just give Claude the 10Ks, it spits it out pretty perfectly. And then even with AI too, I think using like apps to track certain things for research, like for we were talking about Dutch Bros and some of like the retail storefronts making an app now. Anytime like it spots a new Dutch Bros or say a new Kava or Chipotle pops up like on your Apple Map or your Google Map, One, it will track press releases for if the company will like just announce that they opened a new location. And if they don't do that, if this new location just shows up on the map, meaning it probably opened that day or it's going to open within the next week or something, being able to get that information that's otherwise kind of a pain to search. Like if you want to find out if a new Starbucks opened up near here, one, you're going to need like a knowledge base of every single store that's around here. And then you're going to have to search the map function every day to see if something new popped up. So it's kind of unlocking a lot easier ways to do more kind of in-depth and granular research.
Interesting. Yeah. Those are, as you were speaking, I was just thinking, those are sort of this analytical pulling information, organizing information, spotting information, organizing information function of AI. And that's high. I would say that scale and speed-wise, we're talking about in months as weeks, right? That improvement from November to now, and every other week this seems to be improving, right? It's a huge part of the research work, absolutely. There's also another aspect of maybe more from where I'm sitting of the portfolio manager seat, where a lot of times I use it for cognitive abilities, for its actually depth of thought, and for its and I have to give it credit where it's due. I think this, if you're on Opus 4.6, we also have the Cloud Max plan now, stuff like that, just to make sure our tokens don't run out.
Yeah.
I give it very, at this point, knows me pretty well as a my style as a portfolio manager, and knows the track record is proven and all that. So I give it the prompts, I give it the thoughts are exactly how I think about it. Let me put it this way. I think, and I like analogies, so I'm going to use this one. But it eventually points back to what we're talking about in finance, in investment decision making. But this is just like a general analogy, if you will, and people hopefully don't take offense to that. We did enough disclosures. For example, the research capabilities you're talking about in the world like dating or something for guys out of college, graduating, things, whatever the case may be, that might be just like a career, might be a big thing. It's you're getting profiles of people and gathering data. That's essentially what we're talking about. But I would talk to it about, should I marry this person? Or if I were married, would I divorce this person and why? Those are consequential decisions, right? So in the sense where like, I would go through, be like, both, sure, Tim Cook bought some Nike and Elliot Hill bought some Nike. Great insider confidence, great. But they also bought at 65 and they're down like 40% since they bought it.
Yeah, and I think Tim Cook bought $1 million, so...
Yeah, I'm saying before at $65, he bought like $1 million as well, and those were become $600,000 already. So I'm saying like the insiders could also be horrible investors, right? But anyway, so obviously that's not the conference. So I dive into it and I go, for both a decade of losers, Disney and Nike, but great companies, great brands still, nevertheless, which one would be a better buy at the current prices, given the product landscape, all type of things? And I went on a tangent internally already to tell you how I think about Nike, how they didn't monetize SGA's MVP season, how they didn't. They should have sold Nike in China's business versus still tanking, by the way, down 30% year over year, versus going to a JV situation and selling the stake like Starbucks.
Still getting down. So
I give it actual thoughts of like, what is a 37%, what is a 7.5% position versus a 6.6% position?
Yeah, what justifies kind of that 1% extra that you're going to allocate to it?
And what is like the difference between like qualitatively where this moat around, let's say, deployment of media and everybody has a streaming platform, but having, physical assets around, or, Nike still has, again, probably the most iconic brand in shoe logos, at least, right? You can tell what an On running shoe looks like. You can tell what a Hoka shoe look like. People know what they look like, but the swoosh so more. But then, what value do you put around that? Those type of things, like these type of very deep. Sometimes I would say only when I'm sitting down. Like yesterday, I did that. One of that, like I think my laptop was charging just like 40 minutes from 3:45 to 4:30. I would just only with my phone with Claude. I was probably the most productive 45 minutes I have this entire week. It was like back and forth going. There's a bunch of other companies down there. There's DoorDash, there's Zoom. Zoom was because the Anthropic stake basically doubled. And then I was going back and forth with it. So I think that here's the key. I talked to a few of my friends around this too, and my partner. I think the main thing is, if you know what you want, if you have principles around how you make decisions, it's a very good thinking tool. In the sense where, if you kind of get pushed, because if I say I slightly lean towards this, I will call back. I'll push back, be like, no, I don't like this, and blah blah blah. Like I'll be like, I think I like blocking this sense, and blah blah blah. It would tilt the weight because reinforcement learning. So I think this is also the key part. I think for especially people who's in the non-Silicon Valley ecosystem or non-engineering ecosystem that who didn't study reinforcement learning, let's say, because my reinforcement learning friends always remind me this. What it's based on is to make you happy. Reinforcement learning at the core is to reinforce things. It has a token function and reward function. The one of the key reward function inside ML. Again, I'm not. I'm outside in that industry, so I'm using my best to explain. My best to explain, I could be wrong, but at the core, the ML algorithm wants you to be happy with the response, and therefore prompts more response to type of things.
Yeah, so it uses kind of what it knows about you, I guess, to try and give you the message that you want to hear, but then also what you need to hear isn't always what you want to hear. So
exactly right. What you need to hear a lot of times is what you want to hear. So I have that. This is the part where I see there's slight divergence, if you will, as the model improves and as the maybe different weights and different training, different tastes builds them to different personalities too, right? ChatGPT does it way less so, and Claude does it more. It'll push back to me now. Now it will be actually certain times, not all the time, will say what I need to hear. In a sense where like I was going on this whole insider buying train of like looking at what Elliot Hill's doing and what Tim Cook's doing, board member, getting a long time partnership between Apple and Nike and Steve Jobs.
Yeah, I think he's been on the board like 20 years. So.
Steve Jobs said it in 1994, said his inspiration to building Apple was actually Nike because of how they marketed. He said they never say the air bubbles are great. They market great athletes, right? Marketing is about values. Marketing is never about your product. Nobody gives a shit about your product. It's a very noisy world out there. People care about you, what you represent, who you are as a person, right? So,
yeah, if it's good enough for Michael Jordan or if it's good enough for Kobe Bryant, then you should have no problem wearing their shoes.
It's about values, yeah. So in that sense, like I think, I was going a lot on that, and then actually it comes back to be like, no, this is with your prior conversation. Obviously, it has long context memory now. How you look at investments rigorously, and how you look at how the product's evolving and the deteriorating aspect of China sales and those type of things. This wouldn't be something to buy at this price, and you did price work around it. It has my DCF update, like it's saved all in the memory and stuff. So it's like you should stick to your prior framework at $30 to $36 per share. That's where a pure value entry zone. Like it's very clear about that.
Yep.
At this 45, whatever ish adding, the asymmetric ratio is not what you want it to be. And even though the insider is buying, it's a good sign. It's encouraging. It's not a bad signal.
Yeah.
But it's not all green. And insiders bought before, and they will run before. So, and I go, all right. Not solely because it told me that, because I don't know if it's Claude, it's a he or she. Let's just say and we won't jump in the whole rabbit hole of like, do they have are they sentient beings or not?
Yeah.
That's a whole different conversation. Let's just say it, not because it pushed me back. It's because the framework was embedded. The memory, that's
it essentially saved it to the skill file or to its memory, and now it knows to kind of push back on you, kind of counter your points, poke holes in the thesis a little bit.
Exactly. Kind of also explains why Sendix is up like 238 times in a year. Because you need memory chips to store these things, which is somewhat rational in a sense, which that's something we invested in. But that's life changes, and you look at how cycles and be ahead of cycle. That's great too. Tiger, one of the I believe Chase Coleman at the conference was the Robinhood conference of the Robinhood org, another company. It's a New York City charitable foundation in October. Chase Coleman at Tiger Global said memory chips will have a huge year, a banner year. This was October 25. So it turned out to be the case. Anyhow, because of how memory, it's being so it kind of knows a lot about you, and then knows the principles and what we hold. So essentially, it's accelerating, empowering in a way where, in the sense where, I think the better you know your principles and hold your ground, then it trains on this rational version of your framework. Then at certain times, even if you can push it really hard to say, I'm going to change it, wrong. And obviously, I don't have to respond to the prompt. I can just go ahead, execute them and buy it, right? This was yesterday. But then I think, no, it makes sense. Then I pause on a Nike buy, right? Because otherwise I will go again, right? So in that sense, I think with both obviously organizing data, prepping work, that aspect of research increasing, but also thinking, I think we're getting to what people call it. It's a very cliche word of it being AI native, just like being internet native in the early 2000s or later on. Like definitely, for my teenage upbringing, like being internet native or not, it's a big difference for most people, right? being AI native, I think we're getting to, again, these are our 2 cents from a pure value perspective, from an investment research perspective, of if one can have both. So now you have your left hand, you have right hand, in a sense where you use it for quantitative research. You use all the tools, it's getting more accurate. It gathers information at a speed that's never seen before. And then you use it as a guardrail against your thinking. I asked it like, again, important decision makings are hard at the core for all because that's why I use that monumental decision. It's like you can research, have all the dating profile of like, you can have an AI bot to check like, for a single person to check every single profile and get every single data and make sure the photos are real, whatever, all that along the research process. But there's the other part, be like, do I fly over across the country to marry this person? Or do I or do I go to this reunion or not? Or do I like those, some of them are, or do I start a company with another co-founder? Like, people make these decisions, right? That's why I want to give this analogy for people to like, to see how monumental it is just as in portfolio management to buy Nike stock or not, let's say. If both sides are well used and well trained, but also with, most importantly, your framework, your input, your principles, then I think we're probably getting close to what actually the cliche saying is called AI native. That's where we're going. Anyhow, I think it's something that it's evolving with models and evolving with how we use it as well. So,
and I mean, like you said too, that's kind of where the edge comes from. Everybody could pay $100 a month, $200 a month for whatever Cloud Max subscription you want to give it. But it's what framework you give it is really where you're going to get the edge out of it. So knowing how to use these tools and then knowing how to make sure that it kind of has your framework of thinking. And then also, like you said, making sure that it is balanced enough or telling it to kind of push back and fight. So it's not just giving you a confirmation bias 24/7, telling you exactly what you want to hear within your frame of thinking. So,
yeah. And that's the part I talk to all my friends about, my partner, my family. Like, that's the part I don't know what the answer is. It's open-ended in a sense, but where did the framework come from? The framework come from flipping through Yellow Pages in Buffett era, and come from me reading through all the 10Ks and the shareholder reports. I don't have a Bloomberg terminal subscription when I started. I just go to our website and read every document. The intuition came from doing the raw work to build the intuition, though. Then the intuition become a framework with validated market results. Then become a framework, and framework can be reused to AI. But if one were 18 years old to start, 21 years old to start today, or I don't know, elementary school, if they were investing, Buffett was interested in investing at 12. If they were to start today with AI directly using reinforcement learning, there is this sort of caveat that, especially researchers, ML researchers, typically they push harder back on this than the usage of AI, saying because it's trained to give you reward function to make you happy. Then where does the framework get built? The answer is very wide open. I don't know the answer actually. And that's probably the most important thing. You don't talk about this too. The most important thing in life is not give answers, to ask questions. I know I'm asking the right damn question every day. I don't have answers to most things in life, but I'm asking every day. I'm asking the right questions. Right. One of this is on the School of Greatness podcast. Literally, that's called one of his last podcast interviews. Obviously, didn't know that before the accident happened. It was like late 2018 or something. He said there's a lot of there's a lot of answers I don't have. There's a lot of questions I don't even have, but I'm going to keep going now and pursue them and find out more about life. That I feel the same way too, even in this particular arena, that luckily the framework was built and validated with outcomes. Remember we had that conversation about servicing firms that build based on services and outcomes, and then service will be a lot harder because AI essentially provides general services now. Like every single app can be provided like a CRM, like any type of service, right? Legal text, like all this. Like how many stories have I read? You probably read them too, like the last 2 weeks tax season, right? Today, I think
people doing their taxes,
and people like save tell me these stories, like say save $2,000 on the taxes from running it through Claude, and the CPA made a gazillion mistakes, send it back to the CPA. CPA says, "Oh yeah, I admit it. I'm so sorry, I'm wrong." And then here's your $2,000 refund. Like how many times like that's been done versus before? And obviously, so it becomes a general purpose servicing tool versus outcome. So, I mean, in this case, yes, very lucky started before the AI era, and then the results, the framework were validated with markets. But how do one develop in going forward? And also something, as we continue to update, and this won't be the only time to do your research process or teamwork process, you and I's conversations. I think hopefully it's a good educational guideline, at least for people. And the thing is, for people who really love the game, right? Can be basketball, can be whatever it is. We're out here shooting jump. We're running hard sprints. We're playing jump shots right now. You're catching the ball at the elbow. I'm like, hey, hit him. I'm going to bump you here and you shoot it. That's like they will love this view from practitioners. This is also what I think the future of education might become, and what college education a lot of times is missing. I hope, at least, again, we don't have to answer it, but I think we're asking the right question in the sense where if someone was interested in this game, they turn on, their YouTube at home and they watch this, and they're like, wow, I'm listening to two practitioners who truly have skin in the game and are working on this. And these are the tools and processes that what they were doing. That's also, I believe, the power of open source, the power of a lot of, they're gonna replace me for what I do. They can welcome that. It's great. We all have a limited amount of shelf life too. So the baton need to be passed on anyhow. But the point is that I think that level of insight is needed. That's also when I kind of skip most of my shout out to Professor Linsky at Berkeley. But besides his classes, I kind of skipped most classes, finance classes, especially in college. I just watch Buffett's videos on YouTube of Berkshire annual shareholder meetings.
You have access to the best right there. So
yeah, and it is arrogance at the time.
Advantage,
It is arrogance at the time. I would call it as what it is, because I was like, okay, if these professors are so good at what they do, why didn't they just go do it? So
yeah,
so that's why I was like, I mean, just watch the best that's ever done it, that type of thing. So I think this view from especially I think investing a lot of times it is in the do. So from a practitioner perspective, I think in practice, there's a lot of nuance around how we use tools, especially AI is the hot topic now, but obviously other tools and how we think as well.
Mm-hmm.
So anyhow, that's the part I always wanted to update people on each time. And I'm sure maybe 3 months later, we think about it differently or maybe 2 years later, who knows? So yeah, that part's interesting. Cool. Why don't we kind of did it reversely, which is awesome too. And tell us about your background a little bit, personal interest in investing, how did it get started? How do you how's your life?
I guess we kind of touched on it to start. Graduated from Cal State Fullerton May 2025. Did some investment work there, managing real capital. The outperformance funded scholarships for the school, so didn't have skin in the game, but there was also some really good incentives there with our fiduciary duty, knowing that our returns were doing something good. I guess broader than that, deeper than just kind of my educational background and how I got into markets in the first place was watching my dad run his own business for about nearly 30 years. And then kind of on his own, doing his own work in the stock market and investing, kind of learning about it that way. And then wanting to kind of, originally my goal, I wanted to work with him and take over his business. He decided to retire a little early and all that. So I went to school, decided to be a finance major, was kind of undeclared until I transferred over to Cal State Fullerton for 4 years. I didn't know what I wanted to do within business. I signed up for the Finance Association at the school. It's general finance club. It's like corporate finance, investment, all that. So pretty broad. And then through there, found more in-depth, student managed fund club that I talked about. So being able to go more in-depth into markets, learn about it that way, learn from a professor who actually worked in the industry for probably 30 plus years, managing different funds of different amounts. So learning that, getting the firsthand experience, and then kind of getting that bottom-up security selection. And then kind of seeing we're doing our rewards, our funding scholarships, and having that fiduciary duty. No matter what you're doing, I think we're driving upside for our clients. No matter what, we're personally aligned, so we're gaining for it. And then also too, it's kind of like the aspect of knowing that you're doing something good for somebody else. And then also when it's also not just your money, obviously you don't want to lose any of your money, but I think kind of that added sense of pressure and added sense of responsibility gives the job some meaning too, knowing that you're driving positive outcomes for others is one thing that just really drove me to this career. So being able to help others and then kind of the pressure that puts on you is something I enjoy. And then like I'd previously mentioned, kind of finding solitude within the deeper research process and just kind of wanting to wake up, come in here, research, learn more about something every day and keep finding ways to kind of hone in on that research process. And then kind of coming in here, I've only been here since late December, early January. So super early stages still and just working on finding ways to better the process every day.
Awesome. What's your favorite specific part of the day? It could be I'll tell you mine as an example. Earnings calls, generally, and it doesn't have to be earnings season. I go back to a couple calls ago or something. I would listen to a call. Well, actually, that's my second favorite. My favorite is watching a CEO interview. So the people, a Jack Dorsey, Sequoia interview that I think I put on the long view, an hour. Both Ruloff and one of the partners at Sequoia and Dorsey went on there. He's a board member at Square Block. And then, they kind of talk about his change and stuff like that. It was remote, actually. It was a Zoom. Unlike our podcast in person. I would prefer they sit down, actually, in person.
Yeah, face to face.
Anyhow, so watching a CEO interview, laying out strategies and examining, eye contact. 70% of communication is nonverbal. I'm like, is this person BSing me? Is this person being very corporate, taking over the job for 3-4 years, earns the compensation and never, see him again?
Yeah, gets their check and leaves, kind of.
Yeah, or he was really passionate about what he does. In the case of DoorDash, Tony Xu built the business and how he because he drove around Palo Alto and delivered, food. And at the time, it's called Palo Alto Delivery.com. And then changed to like those. So, okay, I'm like, wow, he lived and breathed it. But sometimes being a founder also limits the review, right? One can argue, I can point out a few things that, we like Airbnb as a company, and I like Brian Chesky, but a lot of times being a founder, I can argue certain times maybe makes him more biased towards what Airbnb was and what it needs to become, right? Anyways, but those are my sort of my favorite times, and earnings calls. What's your favorite piece? Like, could be reading 10Ks, could be our investment, could be anything. Like, what's your favorite one part of the work that you like the most?
I think the thing that I like the most, or at least like when I find these types of companies, is like when it's most rewarding. For example, I won't say by name, but there's a few companies that we found recently. One was like 1837, I think, founded in 1888, 1923. Finding all these companies that kind of have like 100-year plus like operating histories.
Cool.
And then just learning about it from the start and really kind of, part of it too is also, it's like I said, I love to learn and just kind of get really into like that in-depth kind of find the piece in that research process. So I think when there's something like that, where one, if a company's been around since 1837, I don't think it's going to go anywhere tomorrow or in the next 10, 20, 30 years probably. They've already been around, say, like if you've been around 150 years, where are you going to go in the next 10 years? So I think trying to find something like that where it just has long staying power and long history, and then seeing kind of how's the business changed since then, is like the philosophy changes. It kind of, is there still any like original family names involved in the company, and just trying to understand the people, how have they like stayed there, how have they maintained an edge for over 100 years, in some cases nearly 200 years, leading your market. I think it's just like a great case study on how to find a great business. So I think finding something like that and then learning all the history and then trying to figure out what it's like for them going forward is what's been my favorite, and my favorite kind of companies to uncover and research.
Interesting. Yeah. And the process of finding out those existed and then diving deeper into what happened and the why and the
find like this company that's been around since like late 1800s and have no idea that like their product is in like so many things that we see in our daily life. You'd have had no idea that this company's been around since like 1880 or something. So
awesome. Yeah. And that process of unlocking the intellectual curiosity and going through it, and it's an amazing journey. Absolutely. Yeah. Interesting. Yes. I think people, because the day, how we spend our days is typically how we spend our lives. The days are interesting. You got to find your favorite part of the work too. Like everybody has their flavors in a way, right? That's cool. Yes. That's sweet.
Yeah, so I guess if you want to say like one specific part of my day is like when you're like kind of going deeper into the 10Ks, taking notes on everything, reading, and also I think it's important to also listen to the management calls, not just read the transcripts. So getting to listen and then take notes alongside that.
We're good balance. We're good balance. I'm on the management call side. You're on the deeper into 10K and history part. That's cool. Cool. Great. So that anything about other than finance, investing, anything about life that you find like growing up could be something you've learned, something you learned from other people, or something that's interesting, or like fun facts you want to share?
I think one thing growing up, I was lucky to travel a lot. So getting to experience like so many different cultures, and then kind of being able to, it helps you really understand lots of different people, why different people do things, how do different people see things. And I think from investing too, that's also really like you need to understand, because companies make money by people purchasing. You need to understand these people. Why are they doing this with their money? How do they think about their money? Kind of how do they think about their life and all that? Because you truly need to understand the people that are purchasing the product, or else you could just underwrite a horrible investment. So I think that's one thing that I'm grateful for, is being able to have traveled so much and learned so much about different people, different cultures. And then also that kind of plays into, like I was saying, like history with with companies. You're also taking in a lot of history with kind of everywhere that you travel to. So that. And then I guess in my personal life too, kind of also playing into like finding solitude within the research process. I've never been, obviously love basketball, team sport, but most of the sports I've actually spent lots of time playing and getting personally into is cycling. So if it is a team sport at the end of the day. But obviously there's a lot of time too, just training by yourself, nothing but you and the bike, and just kind of silence and just trying to push yourself as hard as you can, push yourself to the limits, recover next few days, and then get back at it, try again, push harder. And then kind of tying that in with hiking too, is just going out there, go walk for 20 miles up to the top of a mountain that's at like 14,000 feet, just kind of pushing yourself as hard as you can go to get to places. I mean, I don't think too many people can say that they've been like to the top of a 14,000 foot peak hiking from like the base. So
which you have been a few times, right?
Only once that happened, but yeah.
Okay, which one is it?
Mount Langley was the one I most recently did.
Awesome.
But I think
how old were you when you did it?
How old?
Yeah. Which year?
6 months ago. So
Oh, awesome.
Yeah.
Did you go with your friends, family, team?
it was just me and my dad backpacked up there. So
Awesome. How long did it take you? Tell us the story. Like,
all right. So
how did it come about?
basically,
First of all, was it your dad wanted to go? You want to go?
yeah,
along with him?
we've always been into like outdoors, kind of nature photography, camping, just kind of, I mean, it's nice just to get out there, especially like doing investment work and being like news is constantly coming through. Things are constantly changing.
Yep.
I think when you have the time off, like being able to get out somewhere, like go camping, go backpacking, go
This
somewhere.
is my time off right now, by the way. Yeah. Doing a podcast is like it's a hobby for me. Anyway, keep going. Yeah.
I think for me doing those things where it's just so peaceful when you're like so into kind of like the hustle and bustle and there's constantly things coming across your computer, red news banners, things are always changing. Kind of going out there and being able to hike, take in the scenery, see whatever wildlife. I think it's just such like a rapid change of pace to something that's so much more slower and relaxed. Even though there is like the physical exertion, one, that's something I mind because I like staying healthy, like trying to better myself, get faster, be able to do bigger, harder hikes, whatever, bike rides. So that's
that's awesome. Yeah. And did it take you guys? What's the exact duration take you guys to climb up there? And did you?
I think it was like 7 miles to where we camped.
Okay.
So we camped out, backpacked. We had like 40, 50 ton backpacks, bunch of fishing gear, tents, whatever.
Okay.
So we hiked up 7 miles, and then it was probably another 7 or 8 miles. We camped the one night. Next day,
Nice.
went all the way up to the top.
Nice.
And we got a super late start, so we were getting back. It was like pitch black, whatever. That was like a 8-mile hike.
Okay.
And that probably took us about 8 hours just because it was kind of, there's a lot of scrambling, rock climbing. We took they told us there's like this trail called, it's like Old Army Pass and New Army Pass. And it goes like 3 miles shorter if you take the Old Army Pass. But that's like actually, we had to like throw our backpacks off. We were like squeezing through all these tight like rocks and having to like throw our backpacks up and then climb up. It was a lot more technical than we thought. So it ended up taking forever.
I see.
But
yeah,
I mean, that's just part of the adventure. So
yeah.
But yeah, it probably took us like 8 hours, hike back down, camped the night, and then hauled out the next morning. It was kind of brutal leaving, doing that same hike out after. But
I have a whole graphic mind of this movie inside my head already.
Yeah,
Tossing the backpacks and deciding maybe if the old army trail is too hard, maybe ditching the backpacks or something. But then you wouldn't have food.
Yeah, we wouldn't have water or anything.
What's the reason for taking the fishing gear? I imagine that's
just because it's one of the only places in the state where you can catch a golden trout.
Okay.
Or up in these lakes.
Not up to the top, right?
No, not at the peak.
Okay.
Yeah, down where we were camping.
Okay.
Yeah, there's enough fish up at 14,000 feet. But,
okay, but then did you guys actually catch them?
My dad only caught 3 and I got like 1 bite and we carried all his gear for not too much. So
yeah, that's why I was thinking fishing gear might be a little overkill for them, but it's definitely fun.
Yeah.
Yeah.
Yeah,
So
you could catch it.
caught
You could
3,
eat it.
right?
Yeah.
You had 1 bite? How so? Because it was not cookable?
No, I mean like I had one bite on the, like I didn't actually catch a fish. Like it just bit the line and then took my lure. Yeah.
Oh, got it. But he caught 3, right?
Yeah, he caught him. We could have eaten him, but we came prepared with like freeze-dried food and whatever.
Oh, okay.
So, yeah.
Okay. Free. So you took it home and you cooked it later or something?
No, just catch and release just for fun.
Oh, catch. Oh, okay,
Yeah.
got it. Okay, do the catch and got it. Okay. I thought this had like a practical.
No, it's just like
survival
pass
purpose.
the time.
Oh,
up there.
got it. Okay.
If we were genuinely starving, yeah, we could have done more fishing and ate the fish, but
Oh, got it. I was thinking the whole supply. Food security.
Yeah, we could go out there and do that, but
catch and release. Got it. That's fun. Yeah, that's awesome.
Yeah, it's
cool.
just a nice pastime. So
yeah, cool. And what about the cycling experience? You did a bunch in high school, right? Pretty
yeah,
seriously.
cycling. Yeah, I was on a junior team.
Okay.
Doing some races.
Yeah.
I also got into that with my dad. He did some amateur racing. Probably
was it pure team race for you, or was it individual, like solo races?
No, you're in with a team, probably like 8 to 12 people, just depending on the day. But
okay, in a relay style, I don't know cycling.
No, it's all essentially the way like cycling races work.
Yeah,
is like I'll use the Tour de France as an example, just because probably most well-known thing out there. So
absolutely,
you have like 8 people. You have like 8 people on a team, but really in reality, only one of them is like there to win.
Yep.
So you have you're say the one that's going to win. You're kind of the team leader, and then you have these 7 or 8 other people. They're the ones that are like sitting at the front of the pack. They're sheltering the leader from the wind because obviously there's a bit of that. Like if you don't have the wind in your face, you kind of have a shield.
Yep.
And you waste a majority of your energy just pedaling against the wind.
Yep.
So if you're able to sit in that shield, you can save so much energy.
It's
and
like
then that's
DRS
kind of,
in Formula One.
Same thing. Yeah, DRS. Yeah.
Yeah, in Formula One. Yeah, I'm a big F1. So yes, aerodynamics.
Yeah, I'm into F1 a bit, but not as much as you. But
but aerodynamics works out in favor. Okay, I see. So
Yeah.
there's a couple of people keep going. So there's the aerodynamic.
Yeah.
aspect.
So essentially, you just have like 7 or 8 people that are doing all of the work for 80% of the time, 90% of the time, and then it's like a mountain stage. You have your whole team protect you all the way up. It's like maybe 120-mile day. You have people doing work for the first 105 miles, and then once that time finally hits, it's time for the leader to pull through. He's fresh, and then that's where it's really time to shine. So I think for here, I wasn't as into because the racing here is mostly like criteriums. It's like you go in a business park and you ride in a circle for like 45 minutes at like 30 miles an hour. It's not one, there's no scenery, so it's kind of more boring. And then also for me being a lighter person, I was never the one that was actually like going for the win or anything, just because like you need to have kind of like the mass moves mass, and you need to be like 150, 160 pounds or whatever
to actually break wing to be the cap to
be
leader.
like on a flat race, like you're in a criteria. We need to be kind of like a stockier sprinter kind of build. So,
but not 220 pounds or something.
No,
right?
no,
like
no. Even
like
at that pain, yeah.
So like a good balance, but not too heavy.
Yeah, okay. Like 160, 170 probably. But
so, and then being lighter person, generally, are you doing the protecting or are you doing
doing the protecting in that case, because I'm not going to be the one to win on that. So kind of helping the teammate, setting up, doing all that work for kind of the first 80, 90% of the race. And then.
But when the team wins, everybody gets a medal, right?
No, it's only one. So there's a lot of kind of selfless work in and being the teammate that's not winning. So
they don't give you a medal to be the part.
No.
Interesting. Is it all like that, or just this particular competition?
No, that's how it is across cycling broadly. I mean, like if it's like a multi-day thing, obviously you read the Tour de France, you're judged. It's if you have the lowest finishing time. They'll do it like the team that has the lowest cumulative finishing time. And that may also not be the winning team. It could be somebody, say you have like one rider in the top 10, but then the person who wins the team classification, they have 5 riders in the top 10. And you could win it that way. But I guess that's really the only sense of team recognition. Other than that, it's kind of your teammates obviously know what you're doing, but like to the general public, it's kind of a selfless job.
Yeah. So. Yeah. Interesting. Wow. That's fun. And how did you get into it? Remember, like, what was the your dad had bikes and you ride them?
Yeah, I mean, from probably learned to ride a bike when I was like 3 years old or something. And for as long as I could remember, my dad was super into road cycling. Like I'd be like 2 or 3 years old. I remember him coming home wearing like whatever, like the like Lyrica, like tight skin suit. Whatever, he came home doing that. I learned how to ride a bike super young. Was always into it. And then probably around like middle school, I got into mountain biking. And then from there, kind of moved into road biking, got a little bit faster, started doing a lot of training, got into racing from there. So it's kind of, I mean, just like emulating my dad, I guess. A good person, obviously. If you could be just as good as your dad, I think it's kind of one thing you want to try and do. So
awesome, that's great. And you mentioned his business too. Tell me about the business side of what was there the business that you initially wanted to run, and then later, like to the extent that you want to share.
Yeah, essentially, I mean, he ran a t-shirt screen printing shop for about 30 years. He did a lot of work, mostly with like skateboarding companies, BMX, so kind of like a lot of street, skate, surf, kind of that type of stuff. And then also for a lot of like rappers and then a lot of popular rock bands, he made their tour t-shirts. He did that for 30 years, like I said. And then kind of, in middle school, I always kind of thought that I would want to do that and want to take over. And then at that time, also a little bit younger, a little bit more naive, didn't know kind of all the headaches and some of the other stuff that comes with running your own business, especially for him. He had like 100 employees. So it's there's a lot to manage. And I think that was obviously one thing that I wasn't totally aware of at the time. And then with the time I was graduating and all that was right around COVID, he kind of chose to take that as a sign instead of kind of like struggling through it, just deciding to retire early instead. And then like if I were to have graduated college and inherited a business coming out of COVID, it's not necessarily something that you I mean, I guess from a learning perspective, it's good, jump right into the deep end. Yeah. But at the same time, it was also for him, he would have had to have stayed kind of like personally aligned and stayed around longer. And it was just, I think, best for everybody, just if he retired early and sold it and got out. So
you probably would have entered into a little Berkshire Hathaway situation.
You
have to turn it around or something like that. You can eventually use your interest and passion investing to make the outside, all the capital outside of working capital great. But then that, the textile situation was
coming in at such like a crazy time during COVID. It's like lots of supply chain prices were probably up like 2 or 3 times like what they'd be in a normal environment.
Did he end up selling for like a multiple or more like an asset kind of situation?
Just an asset situation.
I see. Okay. Interesting. Yeah, I'm sure. But being around it also probably gave you business instincts and those sense. Like
I think that's part of too. I mean, like watching him do that and kind of like knowing what he did and then seeing what happens like within a business and then being able to take that with like also, I mean, obviously it's not like comparable to Apple or something, but at the end of the day, the kind of the same principles. Same principles are kind of there for just analyzing the quality of a business and knowing what goes on.
If you juiced up SBC, and then it will be the same owner's earning situation, right? If you all the metrics apply, right? These are like we don't live in a fantasy world, right? There's business in that sense, right?
Yeah, business is business at the end of the day. So it is
owner's earnings are owner's earning to him, right? But if you like juiced up SBC and like have essentially fully that like employee owned a certain percent, like if that changes,
it's like an ESOP or something,
or if he calls EBITDA his true earnings, then I guess he doesn't tax or other things. That's not possible, right? Or if he leverage like 3x the net debt to EBITDA to 8x or something, then he probably is going to be paying interest rates. I mean, have a high interest rate and pay interest payments all throughout the enterprise life. Probably couldn't exit, right? Because you have to pay out the debt, those type of things. So all the kind of metrics and concept we use to study, granted much larger, but public companies, but they apply to, I always use the example, apply to the coffee house downstairs, applies to any business, right? Applies to our firm, right? Same thing, right? So that's great. Awesome. Cool. This has been great. It's a great conversation. anything else that you can think of that you think are interesting or maybe underrated aspects? This could be anything. This is like one of our like my sort of final round of question, if you will, of like regarding investing life. Could be your passion cycling, could be like we share passion basketball, could be other things that you find reading or movies. Sometimes people recommend those. Sometimes people. I'm a big movie person. Sometimes people recommend following a certain public figure. Sometimes people recommend doing certain things. Or what would be your thoughts? I think there are. It serves two effects. One, it's really good for one to look back on. Like when you're 28, 3 years later, time goes by pretty quickly. And you go back, you'd be like, wow, this is what I thought I was 25. This is cool. Or this is what I thought after 6 months, 5 months-ish of joining Pure Value Capital and working with Robert. And then also it serves as a timestamp, right, for you, for your own introspection. But also I think it's good for the world that people listen and think about, oh, okay, maybe I resonate with Hayden and this is interesting. And that piece of saying changed my life or something. Hopefully we can serve that. But anything else you want to
I think if I had to think about kind of like one piece of advice, I guess, that applies to kind of like everything that we talked about today and kind of like everything in my life, so to say, is I guess you have to be comfortable with being uncomfortable in a way. One, like with cycling, your legs are going to be burning up. You might be like 5 minutes from the top of the hill or whatever your end goal is. You need to be comfortable with that suffering. A lot of it is just so mental. Like how much can you really, I guess, suffer and push through to the end? How badly do you want it? You can't give up. And then also same goes for here. How badly do you want it? How uncomfortable are you going to be? You might be researching. Some of the days are really long, but then on the other end, you might also have some days where it's quite easy. So I guess you have to be comfortable being uncomfortable in order to reap the rewards. Like say we have a 12-hour day in office or something, just lots of deep work, lots of thinking, but then at the end of it, we have an investable idea and that can generate income for the fund for say the next 10 years. So just being able to be comfortable with that and then knowing that at the end of it, there probably is some sort of reward that you're going to reap. So that's just one thing that's always stuck with me too. It applies to basically anything that you want to better yourself with. So.
Yeah, that's right. Hayden's been with me on 11 p.m. nights,
and
those happen. And then also shout out to you for being here. That's being on a podcast. I know it takes some preparation. I know it might not be the most natural strength to yours or the natural things you wanted to do. Right? For me, it's like a vacation, but it's different for each person. And the fact that you are prepared, but also so comfortable and so natural.
And that's part of what I just said too. So
exactly
the uncomfortable part, but growing with it, getting more comfortable, kind of learning, getting into it. So.
If I didn't know you, I wouldn't know that you absolutely performed to that. I would say, and I hope you enjoy yourself as well. To the extent I can imagine, and you were very comfortable, at least from my outside. But see, a lot of times that's why life's kind of hardest lessons. It is internal in the sense where only you know how hard it is.
Yeah, kind of only you know your struggle, I guess. So.
Yes, and then but by me knowing you pretty well at this point, I know obviously it's a tall task. That is something you want to prepare, you want to shine in, but you perform phenomenally. So thank you for being on, and I look forward to our continued journey at Pure Value. I think you have a lot of potential. Like I always emphasize that to you, right? I think the sky's the limit. You have a lot of potential in terms of one, because you have a love for the game, right? You have a lot of passion.
Yeah, you kind of need that, I guess, as a starting place. So
yes, you enjoy shooting the jump shots. I always tell people like you can have. We use NBA as an analogy, right? The whole lifestyles. You have the tunnel walk. You have the right. You have the
sit courtside, walk out of the tunnel, do all that. But you have to enjoy shooting the shots like that you missed.
Otherwise, you won't be good long enough to be in the game, to be in the lifestyle long enough, right? You can have the house, you have the agents, you have all the fame, the spotlight, all that. That gets you into the door, but the average shelf life is like 2.5 years. People are out of the league or something. Because there's a draft class that's coming. There's draft class that's coming next year. There's draft class that's coming next year. There are free agents.
Yeah, if you're riding the bench, there's probably always somebody that can replace you. So.
There are free agents who are like Alex Caruso, Austin Reeves, who are good, who would come take your job too, right? They might not be drafted, but they can be good. They work on the game. So at the end of the day, you have to love the game itself. And I think that's the most important thing. You have a passion and a knack for loving your job, the day-to-day itself. The game is, and the results, I have no doubt that regardless for the company, secondary, mainly for yourself, that I think I have no doubt you will produce outstanding results to match your own. I mean, I imagine your expectations are quite high to match your own expectations in terms of what you can do. And then the returns will be there when we take care of the risk. Risk as in this sense, as in when we take care of the process. When we fall in love with the process, the returns will absolutely be there. So I think, I think my thing would just be the kind of 2 cents for people that young or old, find what you're good at and find what you're passionate about. I think those have to align. Then eventually you drive it to something that's meaningful to you, right? So people have I truly believe this. Everyone's superstar in their own ways. Everyone can be a superstar.
Yeah, you just have to find what it is that you're going to be the superstar at.
Which lane, which arena, what vertical, which trail fits you, right? Literally and figuratively, right? Then if you love actually walking, the man who loves walking walks further than the man who loves that destination, right?
Yeah.
So you have to love to walk.
Yeah.
So catch and release, but hey, it's fun doing the way, right? So maybe too much fishing gear to bring, but hey, that adds a flavor to it. Maybe otherwise you wouldn't go, like those type of things, right? To find something that love the journey, and that's essentially what it is. And doing Pure Value Insights podcast to share the insights and stuff that along the way. For me, at least my version, it's the part of my passion for the game. It's sharing, it's teaching, it's that adds to cherry on top as we continue to do well by our investors, our clients, and ourselves in the meantime. And eventually, hopefully, the long-term goal is to have a Pure Value foundation, right? To be able to help and do things, and that's the next frontier too. And then with that, right, with the platform itself, Pure Value Insights and these type of things, we can actually probably make a bigger name for the foundation and attract more donors, go to better causes, and those type of things. That's also the next step as well. So I think the whole picture all depends on, do you love the game, right? Do you want to be good at a game and then keep working on it? Then all the meaning, all the purpose, a lot of things can open up the doors that way, right? So
it plays out. So just love the game and be committed to it, and everything should work itself out.
Exactly. This has been awesome. Thank you for being on, Hayden.
Of course. Thanks for having me.
First of many, hopefully. Yeah, as you get more and more comfortable, and we'll share market updates probably after earnings call season. So probably let's do this again in about a month as we wrap our head around.
Yeah, run it every 2 months, every quarter or something.
Yeah. Around the crazy earnings season, we'll update on specific names, right? Again, these does not constitute Hayden or my. These are just our personal views, right? We're not trying to solicit or sell securities. And but next time, especially when we dive into very detailed stock-specific names, we'll go full analysis mode and talk about everything, and people can take it at their own bits, right?
So, yeah, looking forward to that.
Cool. Awesome.
Yep.
Yep.
Thanks.
Thank you, Hayden.